Welcome! Today we're going to dive deep into the WeWork SPAC merger. This is one of the most incredible business stories of the last decade, a real roller coaster of corporate strategy, startup valuation, and the wild world of SPAC deals. Okay, let's start with this number, $47 billion. Back in 2019, this was WeWork's private valuation. Can you believe that? They were promising to completely revolutionize office space and were seen as one of the most valuable startups on the entire planet. And then, just 2 short years later, the valuation they accepted to finally go public? $9 billion. I mean, that's just a fraction of its former glory. So what on earth happened? That's the big question we're tackling today. How does a company's value just collapse by over 80% while it's trying to go public? We're going to break down that whole journey from the disastrous failed IPO to its really unconventional comeback using a SPAC. So, here's our game plan. We'll start with the story behind that $47 billion valuation and its collapse. Then, we'll get into exactly why that first IPO attempt failed so spectacularly. After that, we'll look at the SPAC alternative, break down the actual merger with BowX, and then wrap it all up with the key mistakes and the lessons we can all learn from this. All right, first things first. To really get why this all went so wrong, we have to understand what WeWork's business model actually was. At its core, WeWork is basically a real estate arbitrage play. They sign these long-term leases on office buildings, they fix them up, and then they sublet them out on really flexible, short-term contracts to basically anyone, from freelancers to huge Fortune 500 companies. But here's the thing, and this is so important. WeWork was never valued like a real estate company. It was pitched to investors as this world-changing tech company, and that story, that narrative, was everything. And that whole tech company valuation just came crashing down when WeWork tried to do a traditional IPO. To really see why it imploded so badly, we gotta look at the numbers. So, when WeWork filed its official paperwork to go public, investors finally got a peek under the hood. And what they saw was, well, it was alarming. For every single dollar the company made in revenue, it was losing almost another dollar. That is just not the kind of financial picture you see with a healthy, high-growth tech company. This was a business burning through cash at a rate that was completely unsustainable. The market's reaction was, well, it was fast and it was brutal. Investors saw this insane cash burn, and they also saw some serious red flags when it came to corporate governance. I mean, for example, the founder Adam Neumann actually trademarked the word "we" and then tried to charge his own company millions to use it. No joke. So confidence just vanished, the IPO was pulled, and Neumann was pushed out. Okay, so after a failure that public, trying for another traditional IPO was pretty much off the table. The company needed a totally new way to get to the public markets, and that's what led them to the SPAC. So WeWork turned to a SPAC, a special purpose acquisition company. The easiest way to think about it is like a publicly traded shell company, a blank check that raises a bunch of money for one reason and one reason only, to find a private company and merge with it. For a company like WeWork, this was a faster and, honestly, a less scrutinized way to go public. The SPAC that ended up taking WeWork public was called BowX Acquisition Corp. So let's break down exactly how this comeback deal actually worked. The whole process was pretty straightforward. First, BowX raised $483 million through its own IPO. Then it announced its plan to merge with WeWork. To make the deal even stronger, they went out and got another $800 million in private funding from big-time investors. Once the shareholders approved it, WeWork finally started trading on the New York Stock Exchange in October of 2021. So all in all, the deal pumped a much-needed $1.3 billion in cash into WeWork. And that money came from 2 places: the cash sitting in BowX's trust account and that big $800 million private investment, which really helped signal to the market that this deal was legit. This timeline just shows you the whole crazy ride. I mean, from that peak of $47 billion, it crashed hard after the failed IPO, hit an absolute low of $2.9 billion during the pandemic, and then settled right around $9 billion through the SPAC merger. A much more realistic number, right? For any MBA student, any business professional, this case is just full of critical lessons in corporate strategy and M&A. The biggest mistake here was this massive gap between the vision and the reality. The vision they sold was this disruptive tech company that was going to elevate the world's consciousness. But the reality? It was a plain old real estate business that was losing a ton of money with a huge cash burn problem, all kind of covered up by this charismatic founder's story.
So if we boil it all down, there are three huge takeaways here. First, a good story can't defy gravity forever. Your valuation eventually has to be tied to actual financial fundamentals. Second, corporate governance isn't just some boring checkbox exercise. It's the absolute foundation of investor trust, and without it, the whole thing can fall apart. And third, M&A tools like SPACs can actually be a lifeline. They can provide a path to capital and recovery when the normal routes are closed.
This one sentence from news reports at the time just says it all. It shows you the real, severe consequences when you ignore those fundamentals and good governance. It's a straight line. The IPO was scrapped and the CEO was forced out. Simple as that.
Which leaves us with one final question to think about. Was this SPAC merger a brilliant strategic move that saved WeWork? Or was it just the only option left for a company that had completely run out of road?